The global markets presented a mixed yet cautiously optimistic picture as of May 27, 2025. Investors worldwide are navigating a complex landscape. This landscape is shaped by evolving economic data and shifting geopolitical currents. Central banks continue to play a pivotal role. Their policy decisions on interest rates and inflation control remain under intense scrutiny. Overall, there is a sense that economies are proving resilient. However, underlying uncertainties persist, demanding careful observation. The coming weeks will be crucial in determining the trajectory for the remainder of the year, as more definitive trends begin to emerge from the noise of daily fluctuations. We are seeing a divergence in performance across different regions, reflecting their unique challenges and opportunities. Many market participants are trying to decipher long-term signals. They are looking past the short-term volatility that often clouds immediate judgment. The primary concern for many remains inflation. Is it truly under control, or are we merely in a temporary reprieve? Different economies are providing different answers to this crucial question. This divergence makes a unified global market strategy particularly challenging for international investors. Furthermore, supply chain issues, though improved from their pandemic peaks, still occasionally flare up, adding another layer of complexity to the global economic puzzle that analysts are trying to piece together. This requires a nuanced view, region by region. The interplay between fiscal policy and monetary responses also continues to be a major theme. Governments are grappling with high debt levels, yet they also face pressures to support economic growth and address social needs. This delicate balancing act has significant implications for market stability and investor confidence. How effectively this balance is managed will likely determine the sustainability of any recovery. The recent announcements from various G7 finance ministers indicate a coordinated yet cautious approach to these fiscal challenges, aiming to avoid past mistakes of premature austerity or unchecked spending, which could destabilize fragile recoveries. Looking ahead, the market is keenly awaiting further signals. These signals will come from upcoming economic releases and central bank meetings. The sentiment is one of watchful waiting. There is an acknowledgement of progress made in tackling post-pandemic economic challenges. Yet, there is also an awareness that new risks can emerge unexpectedly. This environment favors those who are well-informed and agile. It requires an ability to adapt to rapidly changing conditions. The overall stability seen in recent weeks, despite underlying jitters, suggests a maturity in how markets are processing information, perhaps learning from the turbulent past few years of unexpected economic shocks and policy responses. In the United States, markets observed the Memorial Day holiday. This meant a pause in trading activity on Monday, May 26. This brief respite often provides an opportunity for reflection. Investors reassessed their positions before the resumption of a busy week. Key economic data releases were anticipated later in the week. These releases were expected to provide further clarity on the health of the U.S. economy. The Federal Reserve's stance on future monetary policy remains a dominant factor. Market watchers are particularly focused on any hints regarding the timing of potential interest rate adjustments, as inflation metrics continue to be scrutinized closely by policymakers and the public alike. One significant piece of data due is the Consumer Confidence Index. This index is a crucial barometer of household sentiment. It influences spending patterns, which in turn drive a large portion of economic activity. Expectations were for a slight improvement. This improvement would reflect a stabilizing labor market and perhaps easing inflation concerns. However, any unexpected dip in confidence could signal underlying worries. These worries might pertain to job security or the rising cost of living. Such a dip could potentially dampen market enthusiasm. The nuances within the report, such as future expectations versus current conditions, will be closely analyzed for deeper insights into the consumer psyche. Another important indicator is new home sales data. The housing market has been a focal point of economic discussion. It has faced challenges from fluctuating mortgage rates and supply constraints. Recent figures suggested a complex picture. There were signs of resilience in some areas, but also affordability concerns impacting overall sales volumes. Strong new home sales could indicate underlying strength in consumer demand and builder confidence. Conversely, weak figures might suggest that high borrowing costs are significantly curtailing activity, potentially signaling a broader economic slowdown. This data point is particularly sensitive to interest rate expectations, making it a key watch item this week. the overall narrative for the US market seems to be one of cautious navigation. The economy has avoided a widely predicted recession so far. This resilience is a positive sign. However, the path forward is not entirely clear. The Federal Reserve aims for a soft landing. This means curbing inflation without triggering a significant downturn. Achieving this delicate balance is an ongoing challenge. Investors are therefore parsing every piece of economic news. They are trying to gauge whether this optimistic scenario is indeed materializing, or if headwinds are gathering strength beneath the surface of relative market calm. The upcoming data will add more pieces to this complex puzzle. Across the Atlantic, European markets showed some positive momentum. This was partly fueled by tentative rumors of progress in peace talks related to regional conflicts. While unconfirmed, such whispers often inject a degree of optimism. They suggest a potential reduction in geopolitical risk, which has been a persistent drag on sentiment. Any de-escalation could alleviate energy price pressures and supply chain disruptions. These have particularly affected European economies. Investors are therefore highly sensitive to any news, credible or otherwise, that points towards greater stability in the region. The market's reaction underscores the significant impact geopolitical factors have on economic outlooks. Adding to the more positive tone in Europe were strong earnings reports from several key sectors. Companies in the technology and luxury goods segments, for instance, demonstrated robust performance. This indicated that consumer demand, at least in certain demographics, remains resilient despite broader economic uncertainties. These strong corporate results provided a much-needed counterpoint to concerns about slowing growth and persistent inflation. They suggest that some European businesses are successfully navigating the challenging environment. This ability to adapt and thrive offers a glimmer of hope for the continent's economic resilience and a potential upward trend if conditions continue to improve or at least stabilize. Meanwhile, Asian markets also registered notable movements. There were positive signals regarding trade dialogue between major economic powers in the region. Improved trade relations are crucial for Asia's export-oriented economies. Any easing of trade tensions typically boosts investor confidence and supports market valuations. These developments suggest a potential thawing of protectionist stances. This could lead to increased cross-border investment and smoother global supply chains. The focus now shifts to whether these initial positive signals translate into concrete policy changes and sustained improvements in the trade landscape, which would be beneficial for global growth. Key developments in specific Asian markets, such as Japan and India, also contributed to the regional picture. Japan's market continued to attract attention due to corporate governance reforms and a weaker yen, which benefits exporters. India's growth story remains a strong draw for international investors, despite some localized challenges. China's economic trajectory, however, remains a significant variable. Any policy shifts or economic data from Beijing are closely watched for their potential ripple effects across Asia and the globe. The interplay of these diverse national narratives creates a complex but dynamic investment environment within the broader Asian continent, offering both risks and substantial opportunities. Geopolitical tensions, particularly in the Middle East, continued to cast a shadow over global sentiment. These tensions have a direct impact on oil prices. They also influence broader risk appetite among investors. Any escalation in the region typically leads to a flight to safety. This benefits assets like gold and the US dollar. The uncertainty created by such conflicts makes long-term investment planning more challenging. It forces market participants to factor in potential supply disruptions and heightened volatility. The delicate diplomatic efforts underway are therefore being monitored with extreme vigilance by global markets, as outcomes could sway energy markets significantly. In the commodities market, oil prices remain sensitive to these geopolitical developments and OPEC+ production decisions. Brent crude hovered around key psychological levels, reflecting a tight balance between supply concerns and global demand outlook. Gold, often seen as a safe haven asset, saw some fluctuations. It reacted to changes in US dollar strength and real interest rate expectations. Other industrial metals showed mixed performance. Their prices were influenced by demand forecasts from major economies like China and the progress of the global green energy transition, which requires substantial raw materials. This sector remains a critical indicator of industrial health. The cryptocurrency market, often a subject of intense discussion, continued its characteristic volatile journey. Bitcoin, the leading cryptocurrency, showed signs of consolidation after a period of significant price swings. It traded within a relatively defined range. Investors are watching for regulatory developments and institutional adoption trends. These factors are seen as key catalysts for its next major move. The recent halving event's impact is still being assessed, with some analysts expecting a delayed positive effect on its price due to reduced new supply entering the market, a fundamental aspect of its design. Ethereum, the second largest cryptocurrency, also garnered attention. Its price movements were often linked to developments in the decentralized finance, DeFi, and non-fungible token, NFT sectors. The ongoing upgrades to its network, aimed at improving scalability and efficiency, are closely watched by the community and investors alike. Broader crypto market sentiment remained tied to macroeconomic factors. These include interest rate expectations and overall risk appetite. The potential for increased regulatory scrutiny globally remains a key uncertainty for the entire digital asset class, influencing both retail and institutional participation in these emerging markets. Looking forward, the interplay of these various global economic indicators, geopolitical events, and specific market dynamics will shape expectations. The resilience shown thus far is encouraging, but vigilance remains paramount.